This class is Derivative Securities. My name is Kirby R. Cundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and adjunct professor of accounting and financial management. In this video, we will cover Chapter 13 on binomial trees from the excellent text Options, Futures, and Other Derivatives by John C. Hall. This picture shows a simple binomial model. We consider a stock that currently has a price of $20 and consider the situation where in 3 months the stock will either be $22 or $18. If we consider a call option on that stock, we can have the following situation. A 3-month call option on the stock has a strike price of $21. Well, if that's the case on the day of expiration, the intrinsic payoff value of the option would be $1 if the stock price goes up to $22, but the option would expire worthless if the stock price goes down to $18. How can we use this information to figure out what the option price should be today? We will now look at how to value that option by setting up a riskless portfolio. Consider a portfolio that is long delta shares and short one call option. If the stock price goes up to $22, the value of this portfolio is $22 times delta minus $1, the value of the short call option. If the stock goes down to $18, the value of this portfolio is $18 times delta with no correction for the option since it expires worthless. This portfolio would be riskless if 22 delta minus 1 equals 18 delta. If we rearrange this and solve for delta, we get 22 minus 18 is 4 delta equals 1. 1 divided by 4 is 0.25. So if we were to invest in long 0.25 shares and short one call option, then we would have a risk-free portfolio. If the portfolio is riskless, then it must yield the risk-free rate. So the value of the portfolio in 3 months is 22 times 0.25 minus 1, or 450. The value of that portfolio today must be the present value of 450. If the risk-free rate is 4%, this would be $4.50. E to the minus 0.05 times 0.25 are 3/12 of a year, or 1/4 of a year. So the value of the portfolio today is $4.45.5. The portfolio that is long a quarter share and short one option is worth $4.45.5. The value of the shares is $5, or 1/4 of the $20 it is worth today. So the value of the option has to be, well, let's see. The value of the shares here is 5. We're long that. We are short the option, and the total value is $4.455. So the value of the call option is 5 minus 4.455, or the value of the call option is 54.5 cents. We can generalize this relationship by considering the situation of stock price today is S0. The unknown will be the value of the call option today. The stock price, if it goes up, will be S0 times U. The value of the call option, if it goes up, will be FU. The value of the stock price, if it goes down, will be S0 times D. And the value of the option, if it goes down, will be FD. So once again, we will consider the value of the portfolio that is long delta shares and short one option. So in the case it goes up, it's going to be SUU times delta minus FU. If it goes down, it's going to be S0 D delta minus FD. To be a riskless portfolio, these two have to be equal to each other. our S naught U delta minus FU has to equal S naught D delta minus FD. And we can rearrange this and solve for delta. Well, let's say we take the FU over here, then we'll have FU minus FD. We take the S naught D delta over here, and then we will have S naught U minus S naught D times delta, dividing by S naught U minus S naught D. We get delta equals FU minus FD over S naught U minus S naught D. So for going long delta, this shares, we end up once again with a risk-free portfolio. So the value of the portfolio at time t is going to be S naught U delta minus FU, at least that is one way of valuing it. The value of that portfolio today will be this at time t, and then e to the minus RT to get the present value today. Another expression for the portfolio value today is S naught delta minus F. So we can set this equal to this, solve for F, and then we would get S naught delta minus S naught U delta minus FU, present value thereof. So this will be the value of the call option, and this can also be applied to a put option today. We can also do some not too bad mathematics, but somewhat complex, to get another expression for this involving probabilities. So consider our equation for delta is this. The value of the option is this. Let's say we substitute delta into here, and I'm not going to go through all the mathematics, but you can certainly follow through the math that I have written here and rearrange it, and we can get this relationship and say the value of the option today is the probability of the stock price going up times the value of the option if it goes up, and then a present value term, plus 1 minus the probability of it going up, which is the probability of it going down, the value of the option if it goes down, the present value thereof. Another way of expressing this same thing is we can solve for P. Again, rearrangements here you can follow if you want to, and we will get P as this relationship. So the value of the option is, again, the probability of it going up times the value of the option if it goes up, plus the probability of it going down. We only have two possibilities, so that has to be 1 minus the probability of it going up times the value of the option if it goes down, present value thereof, where this we would solve for is P. So P is a probability. P is the probability of going up. 1 minus P is the probability of going down. The binomial tree model uses the concept of risk-neutral valuation. When the probability of an up and down movements are P and 1 minus P, the expected stock price at time t is the stock price at time 0, future value thereof, or S naught e to the RT, where R is the risk-free rate. This shows that the stock price earns the risk-free rate. Binomial trees illustrate the general result that to value a derivative, we could assume that the expected return on the underlying asset is the risk-free rate and discount at the risk-free rate. This concept is known as using risk-neutral valuation. If we look back again at our original example, using P and 1 minus P, we can say the stock price is initially $20. It has a probability P of going up to a price of $22. Our strike price was again $21, so if that's the case, the value of the call option would be $1. It has a probability 1 minus P of going down, in which case the stock price will be $18, and the value of the call option will be 0, since the strike is 21 and above the final stock price. What is this P? Well, P is the probability that given a return on the stock equal to the risk-free rate, i.e. this. So the future value of the stock, $20, would be E to the risk-free rate of 0.04 times 1/4 of a year. And one possible value would be 22. So if the stock goes up, we end up with 22 times P. Whereas if the stock goes down, we get 18 times 1 minus P. So here's the future value of our stock, and that has to equal 22P plus 18 times 1 minus P. We can rearrange this equation and solve for P, in which case we're going to get P as 0.5503. Alternatively, we can say P from the previous derived equation is e to the RT minus D over U minus D, e to the R 0.04 T 0.25. The probability of going down is 0.9 because 18 divided by 20 is 0.9. The probability of going up is 1.1 because 22 divided by 20 is 1.1. And once again, we end up with our P of 0.5543. So using this alternative equation, we can get the same result for valuing our call option. Well, the present value of our call option has to equal, using the previous equation, the present value term, e to the minus RT, R 0.04 times 0.25, times the probability of going up of 0.5543, times the option value if you go up of 1, plus the probability of going down, which is 1 minus the probability of going up, times the option value if you go down of 0, and we end up with the same result that we calculated earlier, that the value of the call option is 54.5 cents. So we can tell by this that for the purpose of the binomial model, the stock's expected return is irrelevant. When we are evaluating an option in terms of the price of the underlying asset, the probability of up and down movements in the real world is irrelevant. This is an example of a more general result, stating that the expected return on the underlying asset in the real world doesn't matter for either the binomial model or, for that matter, the Black-Scholes option pricing model. What about a two-step example? This is going to use the same up and down numbers. So we have 20 times 1.1 gives us 22, times 1.1 again gives us 24.2. Or if we end up with going down 0.9, 22 times 0.9 gives us 19.8. 20 times 0.9 gives us 18. 18 times 0.9 gives us 16.2. Each of these steps is for 3 months, and we again consider a strike price of $21 and a risk-free rate of 4%. So now the option expires after 6 months versus 3 months. The strike is again $21, so the option expires worthless here since it's a call, worthless here since it's a call, and in this case it will be worth 24 minus 21, or 24.2 minus 21, are $3.20, which we can see here. So how do we get our values of our options now? We know it's going to be worth $3.20 up here and nothing here. But again, we want to know what is the value of the option today. Well, we can work our way back. We will define these as nodes A and B. And the first thing we will do is figure out the value of the option at node B. And the value of the option at the node B has to be, using the risk-free valuation model, the present value is going to be e to the minus RT times the probability of going up of 0.5503, that would be P here and P here, times 3.2, probability of going down, times the value of the option if you go down, which is 0. So this term here gives us the value of the option at node B of $1.74. We then step that back to node A using the same equation. So the value at node A is going to be the present value, since it's a 3-month option, 3/12, 0.25, times 0.04, present value term, probability of going up, 0.5503, times the value of the option at node B, plus the probability of going down, times the value of the option down here, which is 0. And we get the value of the call option today is around 95 cents right here. So that is for a 2-step binomial tree. You can also do a 3-step, 4-step, 5-step, etc. We have looked at 2-step call options. Now let's consider a 2-step put option. We will start with a stock price of $50, and we are told our up term is 1.2, our down term is 0.8. So if we go up to node B, the stock is worth 1.2 times 50, or 60. And if we go out here, it is worth 1.2 times 60, or 72. On the other hand, if we first go up and then down, we will have 60 times 0.8 gives us 48. If we start with our 50 here and go down, we will have 50 times 0.8 is 40, and then 40 times 0.8 is 32. The strike price of our put option is $52. That gives you the right to sell at 52. You don't want to sell at 52 if you can sell at 72. So here the put option expires worthless. At the middle node, the value of the put option is 52 minus 48, or $4. And at the bottom node, the value of the put option is 52 minus 32, or 20. The next step is to figure out the value of the put option at nodes B and C here in the middle, when the probability of going up is 0.6282, and the probability of going down is 1 minus this. Our risk-free rate is 5%. This is how we get the value of the put option at node B. Well, it's going to be the present value of the probability of going up times 0 plus the probability of going down times 4. These terms in here gives us 1.4872, and our present value using 1 year step and 5% gives us 0.9513 times the term here of 1.4872 gives us the value of the put option at node B of 1.4147. We similarly get the value of the put option at node C, same present value term, probability of going up times 4, probability of going down times 20, and we get the same present value term now times 9.9488 gives us the value of the put option at node C of 9.464. We do the same thing one more step backward, 1 year backward, to get the value of the put option today. Same present value term, probability of going up, times value of the put option here at node B, plus probability of going down, times value of the put option at node C. So our same present value term, 9513 times the sum of these, which is 4.408, and gives us the value of the put option today, or at node A, of $4.19. This is for a European put option. It will be slightly different for an American put option, because for an American put option, you have the option here at node C in 1 year of exercising the put. If you can exercise the put, well, the value of the put will be 52 minus 40, or 12, since you can sell here with an American, but you can't for a European. So this number will go up for an American from 9.46 to 12. That is shown here. in which case you will do the last calculation working our way back here to today, and you will say for an American option, the put value at node A, same present value term, same probability of going up, same value of going up, same probability of going down, but now the value of going down goes up to 12 from the 9.46. So now we have the present value term, 9512 times 5.35, and we get the value of the put option goes up to 5.1 for an American, where it was only around 4.2 for a European put option. The delta we have calculated is the ratio of the change in the price of the stock option to the change in the price of the underlying stock, which could also be expressed as the derivative of the change in the price of the option to the change in the price of the stock. Hedge funds and other organizations that create call options do delta hedging and mess with this on a very common daily basis to create those options. And the value of this delta for a binomial tree is going to vary from node to node. How do we choose U and D? Well, if we want to relate our model to the real world, we could say U equals E to the sigma square root of the time to expiration of the option or to the next step, and D equals 1 over U or e to the minus volatility square root of time. And they note this is the approach that was used by Cox, Ross, and Rubinstein. So volatility under Gersanoff's theorem is going to be the same as the real world and the risk-neutral world, so we can use the volatility of the underlying stock and substitute that into the volatility of our model to create a valuation model. So far, we have only looked at non-dividend paying stocks. If we look at stocks that pay dividends and other financial products, we can change what P is. So for options on stock indices, currencies, and futures, the basic procedure for construction of the tree is the same, except we change how we calculate P. Let's consider a more general equation than we've looked at so far and say the probability of an up move for a stock P is A minus D over U minus D. So far, we have only looked at non-dividend paying stocks, in which case A equals E to the RT, where R is the risk-free rate, and change in T is the time to expiration of the option, or in the case of the binomial model, the time between nodes. More generally, if you have a stock that pays a dividend or a stock index that pays a dividend, Q is the yield on that index, and we can say A equals E to the R minus Q times change in T. For a currency, it is going to be similar, and instead of Q, you have R for the risk-free rate, and A equals E to the R minus R risk-free, again times the change in T. In the case of A futures, when you sign the contract, you set the price at which you buy and sell the underlying, say, wheat, so A is merely 1. The Black-Scholes-Merton model can be derived from using binomial trees and taking the limit of an infinite number of nodes, which is discussed in one of the whole appendices, but that is beyond the scope of what we will want to discuss in this lecture series. I thank you for watching this video.